I'm really excited to be hosting or welcoming our closing keynote speaker now, Tavi Costa. He's a partner and portfolio manager at Crescat Capital. They're a Denver-based junior mining fund. So I'm really looking forward to having Tavi on because Tavi's also known in the sector on Twitter and other platforms as well for his macroeconomic thesis and his analysis of macroeconomic events. Also looking back and trying to correlate, like, what is it looking like right now, and have we seen the pattern before? So Tavi, I'm really looking forward to your presentation. And we said you're going to present for 15, and I'm going to grill you for 15. So I'm really looking forward to it.
Okay, so I think it all starts with this chart, in my opinion. I know this chart has been thrown out there quite a lot. It's the commodities to equity ratio at a 50-year low. For me, this is when you think about implementing a thesis today in terms of portfolio positioning, this is what it comes down to. And it's also in the middle of this collision of macro narratives that I see today, which is one of them is this narrative about the roaring 20s that we may see again with a booming economic scenario. And the second one is the liquidity, the forthcoming of liquidity crises, which I'm a big believer of that too. And I believe that this chart right here walks right in between those two narratives. And this is where I would like to elaborate today. To start with, so looking at this chart right now, it's this alligator mouth of money supply in a white line, and the red line is the federal budget. So we have relative to GDP. And so this is pretty clear to me, this monetization of that, where we're seeing money supply growth to levels we've never seen before, at the same time as the fiscal spending is basically at a 70-year highs. And so this is where I believe, the fiat currency problem that we may see worldwide initiates right there. When you look at global central bank assets today, throughout history, especially in annual terms, just looking at aggregating all central bank assets, what you see is that in 2020, we saw somewhere close to $9.2 trillion printed. That is, it completely dwarfs what we saw in 2008 and even prior to that during the emerging market crisis that we saw in 2016. And then 2017 was a great year for risky assets, but they are still printing a significant amount of money in emerging markets, especially. And so this is what comes down to in a positioning perspective, again, going back to the commodities to equity ratio and why we like precious metals so much. When you look at the twin deficits today in the US and you invert that chart, so relative to GDP, this is the red line over there. It basically follows the gold to S&P 500 ratio very closely. And for me, this is where the imbalances continue to sort of support the thesis of buying precious metals, buying a tangible asset, and especially a monetary asset that is an alternative for what we have in terms of fiat currencies relative to risky assets. And I think this, if you go back even further, this chart actually goes back to all the way to the 60s or so. And the only reason why I don't have this going back is because in the 70s, we saw this ratio rise so much that it does not look as impressive as of today. It doesn't give the justice of what's going on right now with the twin deficits. And this it gives you a better, closer perspective of the opportunity ahead for us. When you look at this issue with the Federal Reserve being trapped, in our view, it really starts from a lot of different ways. I mean, the first part of it is what happened in 2020. Back then, what we saw was somewhere close to $4.4 trillion of the CARES Act that was passed back then. So we saw somewhere close to that. And I'm sorry, it's $4.4 trillion of increasing debt that we saw in 2020 in terms of federal debt. We saw the Federal Reserve buying somewhere close to 50% of that. And then so the US banks funded somewhere close to 17% of that. This year, so if you calculated just looking at the total purchase of treasuries by the Federal Reserve and divided by 12, which is the amount of months in 2020 or any year, you get $200 billion a month of purchases of treasuries. This year, they're talking about, they've talked about this before, of about 120 billion, $80 billion in the treasury market and 40 billion in the mortgage-backed securities. But it's been accelerating recently. So we're seeing a decrease of purchases relative to what we saw in 2020 from the Federal Reserve, at the same time as we're seeing an increase of treasury issuances over time, especially coming out of the short duration bonds, going more out to the longer duration. And that's what we're seeing from a 5-year to 7-year. Those are most of the issuances that we're seeing today, and some other longer dated treasuries as well. The problem is that when you look at the net receipts or the revenues from the government side, it's also rolling over, down about 3% on a year-over-year basis. And so who's going to pay down this debt is the big question. We're seeing this chart also been used in a lot of ways before. It's the percentage of ownership of the foreign investors in treasuries relative to the Federal Reserve. We're seeing a convergence of the two over here, where the Federal Reserve is picking up the slack from those foreign investors. I think this is an important chart. What brings us again to the U.S. banks that have been buying they've been lending more to the government than to corporations and individuals, which is surprisingly, we've seen this in the past, but perhaps not to the degree that we're seeing today. $992 billion over what they do in terms of commercial industrial loans. That's what this chart is showing, the spread between their treasury holdings versus what they actually lend to corporations and institutions and individuals. So what is going to come down to? In my view, it's going to come down to an increase of tax rates. And so when you look back all the way to the 1900s and you see the marginal tax bracket in red, and then you have the white line, which is the government debt, surprisingly, or I guess logically, they follow each other very closely. So when you have those big geopolitical events such as the World War I or World War II, that tends to create debt in the government side. And so public debt grows relative to GDP. And in order to pay for that, the taxpayer is basically on the hook. And that's when you see tax rates increasing significantly. And now we have this, again, another alligator mouth where public debt is at a record level, 140% or so. At the same time as we're seeing the tax bracket, or the highest marginal tax bracket in the US, is still actually at 40%. And this is not a political statement at all. I'm just looking at back in history and seeing, look, I think tax rates are going to increase significantly in the following years. And my point to this is especially regarding the equity markets. When I look at the small cap world, the Russell 2000 earnings, I see this, insane estimates for EPS, which is basically 40% higher than the record that we saw in 2018. I don't know if you can see my cursor, but over here, that's basically where it peaked. So we're like 40% now is the estimate above that prior peak. And we're obviously coming down from very depressed earnings right now. So my point is that I don't think a lot of Wall Street analysts are really prepared or really factoring in this large increase in taxes. And to go back to that chart, you can see, I'm not claiming that we're going to go back to 80% here, but you can see those things really spike when we need to. And I think we're going to see one of those here, and I think risky assets are not priced accordingly, especially when you look at valuation models. So at Crescat, we build a lot of macro models and especially fundamental equity models. And here's just one looking at aggregation of 15 different factors in value factors, using different metrics from median metrics, from aggregate metrics, from average metrics, and so forth. And when you aggregate all of those, basically 14 out of those 15, or 11 out of the 15, are at 100 percentiles. So you have another 4, they're pretty close to it, but not so high as we used to see before. So that's where I believe, in terms of the reckoning risk that could derail here in equity markets from those record valuations, is indeed deflationary. The issue with the deflationary thesis is that it's being really met with inflationary responses that we've never seen before. And I want to walk through that as well. So looking at the imbalances from the corporate side, here's corporate debt, leverage, or corporate debt relative to assets or GDP in the red. And then you have the white line, just looking at the corporate bond yields. As everybody knows, it's making another lows here. And so this divergence between the two, which did not used to be the case before, clearly in this chart, the two lines would follow each other, which makes a lot of sense. Higher leverage, higher yields. And since the government really, or the Federal Reserve really took a lead in terms of the intervention and how much they have been intervening in terms of policies, we're seeing this divergence now. And my question is, how do we unwind this situation? And when you think about, again, assets and how to position yourself, what comes down to is looking at alternatives. And when you have almost every asset class today that yields less than inflation expectation, that's a problem. And that's where you start seeing investors beginning to buy any asset that will have a high potential of appreciating in price rather than actually giving the returns through yields. And so that's where it comes down to this tangible asset idea, why we like commodities and all that. And this is actually the first time when you take a plot, when you plot all the valuations. So I'm using Russell 3000 index PE ratio in aggregate terms. You can use almost any metric you would like to. And in the other axis we have here, the U.S. corporate bond, a high yield bond, yield to worse. And what you find here is that this is the first time that I can find in history that bonds or corporate bonds or even sovereign bonds in equity markets are actually at record valuations. That's where the red circle is showing right now. And for me, again, it goes back to the flows idea. Where is the money going to flow in terms of large asset allocators? I think it's going to flow towards commodities, tangible assets in general. And I think gold is going to be one of the ones that are going to be taking the lead in the next 10 years or so in terms of gaining some of the market share from equities and from bonds. And I call this prior chart actually an exhaustion of risk parity strategies, where we're seeing, you know, the whole bonds and equities portfolios is starting to look for other alternatives, regardless if it is Bitcoin or crypto assets or commodities in general. But I think tangible hard assets are the ones that are going to prevail in this scenario. So here we have, how do we value gold? It's just an idea. It's just looking at global central bank assets relative to gold. I've seen this chart from other people as well. It's just an interesting way of adding the two. Surprisingly, if you look at the numbers, they actually look pretty similar. The $32 trillion in central bank assets relative to a target of 3,200 for gold price. Given this model, it's just one model. There are other ways you can price gold, but that's just a way of attempting to look for the intrinsic value of precious metals. Another way of doing this is looking at gold relative to real rates. A ton of people like to do that. My favorite is actually looking at 5-year real yields, because I think that this environment is likely to create an inflationary problem where, especially for the next 5 years. And I think that this chart is very, it represents the opportunity ahead in terms of the pullback in gold prices that we've seen so far relative to what we're seeing in terms of real yields. If you look at, break evens, they're still pretty high. They have not really come down, but we've seen nominal rates moving up significantly. So if you use the same chart here, comparison using 10-year real rates, you see more of a justifiable way of saying, there's a big reason why gold is down. And I agree with that, but I think it's unsustainable that real rates can actually move higher. I think that if nominal rates are going to be moving higher, we're going to see break evens also go up significantly, and therefore we're likely to see a decline of real rates that will continue to support gold. By the way, real rates in red here is inverted, if you haven't noticed yet. But just an interesting idea is looking at this feedback loop that we have from inflation, is when people begin to really hoard hard assets. That's exactly what we're seeing Bitcoin rising. It's not because people are buying Bitcoin to go in the next coffee shop and try to buy coffee with Bitcoin. It's because they're hoarding something, given the fact that we're seeing the policies we're seeing in terms of monetary dilution. And inflation popularity is beginning to rise. Here's just a search popularity rank for inflation on Google Trends, and you can see clearly that it's rising. For a lot of mean reversion types of investors, this would be something to be worried about. But when you study in history inflation, you know that there's a feedback loop here where investors begin to hoard hard assets. It causes tangible assets to rise in price, i.e. commodities, and therefore it ends up creating inflation in the system. I think that's basically what we're seeing today. It's a very inflationary environment. And when we look at commodities adjusted for inflation, it still is near the Great Recession lows. That's the beauty of this. It's still very early in that move, and why we like this so much. And one of the reasons for that is not only on the demand side that comes from this macro imbalances, but also the private investments that we're seeing in terms of mining exploration, in terms of money being spent in this industry of commodities have been declining. This is adjusted for inflation, by the way, and that's why we see that spike back in the 70s. And then now we've seen this basically a downward trend for so many decades. And look at commodities, equal weight index up about 22% since the peak of the market, or right before that decline or the crash of the coronavirus. So those base effects that everyone is talking about, which is all that deep over here, it really is sort of not kind of insignificant in my view, because I think there's certainly I can pick at least 10 other things here in my mind that are up at least 10% today. It's almost like a joke to see this bogus inflation number that came out yesterday at a 2.4% for the CPI, when you see almost virtually almost all commodities and any prices of services are also rising significantly in the last few years. Here's commodities relative to inflation expectation, where it makes you think that if commodities are going to rise, inflation expectations could rise significantly still going forward. But this is one big reason why I think the Roaring Twenties idea has some very valid points here. One of them is given what's going on in the world of the U.S. bottom 50% and the U.S. population in general. We're seeing net worth of population increasing dramatically in the last year or so. For instance, in the bottom 50% of the population. In 2008 to 2011, we saw a decline of net worth of about 84%. This time we're seeing an increase, not only an increase, but the largest increase we've seen in the history of the data. And so net worth for households is improving. And what the Roaring Twenties, I would say, advocates tend to miss here is saying, oh, the economy is at the bottom of the business cycle. No, we're not at the bottom of the business cycle. If you look at valuations of risky assets, it looks pretty clear to me that we're not there either. What we're seeing is a relocation of the imbalances from the private sector to the public sector. So you improved the balance sheets of a lot of the households, and this is factually right. I'm not coming up with this. I mean, if you look at debt to assets ratio of the U.S. bottom 50% or the top 1%, the top percentile, you pick any parts of the society are actually improving in terms of their balance sheets. In fact, the bottom 50% net worth is improving relative to the more richer parts of the society. Does that mean we don't have inequality problems? No, we do have inequality problems. But what I'm trying to say is that we're seeing basically the government handling out money to the population, especially the bottom 50%, and that tends to be inflationary, especially when you come from an emerging market country like myself from Brazil, that I know of what happens when you have money being given to the bottom 50%. Again, this is not a political statement. It's just a macro and analytical work here. And when you look back through our history of inflationary periods, I think it's important to look all the way back to the 1900s. We really had two important inflationary decades, the 1910s and the 1970s. And when you look at annualized return for the equity market during those two decades, basically they went sideways. In the 70s was a 0.47% annualized return. In the 1910s, for the whole decade, we saw somewhere close to less than 1% annualized returns. When you include the inflation rates at the time, which both were running a median CPI, and again, CPI is a very understated measurement of what the real inflation really is, even though I think that back in the days was a more fair measurement than what it is today. Back in the days that we saw a full decade of median CPI being above 6%. And some may be thinking, is he just ignoring the 1940s after World War II? No, I'm not ignoring that. Actually, we saw sporadic increases in CPI back in the 40s, but not really a full decade of very exceeding 6% of CPI on a median basis. And so this is important because I think given the response from the inflationary environment, I think we're very likely we're going to be coming into we might be entering a long-term inflationary cycle. So I'm going to skip this one. And that bit gives me to silver. Why I like silver, why I like precious metals. You can pick some other commodities. I like oil, I like copper, but I think silver is the cheapest metal in the world today. Just an example, what we saw in the Federal Reserve balance sheet, adding about $1 trillion in late 2008. We saw silver going up 434%. And folks, we did see some declines here along the way. We did see some pretty large declines where you can draw a line and come up with the theory that silver was breaking down at the time. And guess what? It came back screaming up after that, and we went up about 434%. Today, we saw a part of that move initially in 2020, and then now we took a pause. Things are going sideways, and now we're seeing this huge amount of pessimism in this industry where I think it's just so undeserved. Silver to money supply, we have a double bottom here where I think silver is incredibly cheap relative to money supply in general. This chart is self-explanatory, but also shows that we're trending higher recently, which is very bullish. Gold to money supply, I'm sure a lot of folks watching this have also looked at charts like this before, but this is, for me, it's always important to look back. When we see back in even a few months ago when people were saying that the bull market for gold was over, honestly, I don't think people are really doing their research and not looking more in depth and looking at gold relative to other things like money supply, where you can clearly see we're just at the beginning of that move, and we're seeing a pause since August with this decline. Here's silver to equities ratio, also a double bottom. I like silver relative to equities. I like silver equities too. I think all of those are attractive ways of investing. And when you think about making money in a bull market, it's not about buying the breakouts. It's about identifying that you have most likely a bull market here, given the macro factors and the environment in general, which I think I have that covered. And the second part is taking advantage of those pullbacks. In the last bull market that we saw from 01 all the way, or 2000s all the way to 2011, we saw plenty of those. Some like to break down this into two bull markets, given the fact that we saw a decline of 28% in 08. That's okay. I'm not going to get into that argument, but I do think that investors that took advantage of buying gold down 30% were the ones that really well rewarded. And so here we are again today, down significantly, and I'm seeing record pessimism in the industry, and not a lot of people really taking advantage of this, trying to raise capital and deploy into this industry that I think will be really the next growth stocks of the next bull market. I want to go through this, Kai. I know I'm going after a little longer than I'm supposed to. I'll try to wrap this up quickly here. Gold to, there is a supply cliff going on in a lot of gold producers. This is a depletion of the proven and probable reserves of gold that we're seeing. This is an important part of the thesis, and there's two parts of this. Most folks here are very aware of this lack of gold discoveries that we have. We're seeing zero large discoveries of gold in the last 3 years or so, which are accounted as higher than 2 million ounces of gold. I think this is there's a reason for that. There's exploration budgets have been really dismal recently, been declining relative to where gold prices were. Actually, this price should be a little bit over here, so it needs to be updated, but still you see this large divergence between the two. The same happens here when you look at miners capex, and I'm really looking forward to seeing what's going to happen in this quarter, because I think it's actually going to decline even further, capex. But we'll see. But basically what we're seeing is a contraction of capex is still relative to metal prices. And so, this is an important portion of the thesis from a supply perspective. When you separate miners, silver was up about 50% in 2020. CapEx cycle for the silver miners, which is not easy to find, to really look for what are silver miners. As we all know, a lot of those companies also have a lot of gold and other metals. But doing my best at calculating this, I see somewhere close to an 18% decline of aggregate CapEx in a trailing 12 months basis, which is pretty interesting. And one of my favorite charts is this one. It's showing that gold miners have been called capital destroyers, rightly so. They've lost money, they've bleeding money for so many decades. And finally, we're seeing what we call a new decade, where we saw 5 straight quarters of positive free cash flow among the top 50 miners in the Canadian and US stock exchange. I think this is just the beginning. I think investors are not doing their homework, that are avoiding this industry, given what the history it was, and therefore not really seeing the large changes that we're seeing here in the last few years. Finally, just a few more charts, median free cash flow, year-over-year change. You can see a growth here of 100+% in gold and silver miners. This is using the top 20 miners because the others, a lot of the others don't have free cash flow. So I got to use the top miners to see this, but it's clearly we're seeing an improvement that we haven't seen before in terms of growth. And more importantly, again, go back to the comparison of one industry versus another. We're comparing now gold miners versus tech stocks, free cash flow yield. And finally, we're seeing this differential becoming positive. In other words, the value proposition for buying gold miners is finally more attractive than tech companies, which I think it's incredibly interesting, again, for a lot of large allocators looking at this. Free cash flow in aggregate terms for the overall industry estimates, you can see that it's diverging from prices. I think this is also a very good setup for gold miners. And here's one that really it really blows my mind looking at this, right? Because a lot of people think we're again at the peak of the market for precious metals, and back then what we saw was that miners are leveraging up. We saw here the red bars are showing the change in short-term and long-term debt for the miners in aggregate terms. And what we're seeing here on a quarterly basis is that we just had the largest repayment of debt in history. 60% of free cash flow created was used to pay down debt. And back in 2011, we saw the largest increase in debt in history. So pretty interesting. So that gives you, again, another idea looking at Russell 3000, all the different sectors in the economy. If the industry was a sector and was compared to the other sectors in the equity markets in the US, the precious metals industry would have the cleanest balance sheets of them all. That is comparing with almost any business model that you can look for, from REITs all the way back to infotech or healthcare. And that for me is incredible again. And for the last chart I wanted to show is the asymmetry to this thesis. It's looking at the overall precious metals market cap industry, which is about 600. It's actually lower than that now. It's closer to $500 billion. And compared that to one company, Apple. You can look, some people may say, well, but Apple makes more money than the entire precious metals industry. Sure. Take any other tech company that is on the top there, and you may see the same problem. Tesla being one example of another one. And so in this case, using Apple, 4 times the size of the overall industry in the middle of, if I told you that we're seeing, the deficits at the size that we're seeing, that the Federal Reserve would be printing as much money as they are, and the negative sentiment we're seeing today, given this imbalance between the overall industry and one company, for me, this is just one of the biggest opportunities I've seen in a long time. So our goal as a fund is to continue to raise money and deploy capital towards this industry. Kai, I'm going to open up for questions. I'm sorry for going a little longer, but there's a lot of things to cover.
No, there was a lot. I think you packed in like a 3-hour seminar into 30 minutes. So it's fantastic to learn about all the different ratios. It's really interesting. And I've been taking notes while you were talking as well. And I do have a couple follow-up questions, and I urge our audience as well to use the chat function for the questions as well. Let's start off with the gold miners first. And you made a couple interesting comments that I want to follow up on. Right, so the gold miners are producing finally some free cash flow, but they're not attracting any attention at all. Like, what do the gold miners actually need to do to attract attention from the generalist investors to turn the ship around?
Look, I think it comes down to a lot of things, different things, but one of them is in my opinion, it starts with the metal prices. Obviously, underlying prices of gold and silver need to change in order to justify the reason for investors to go up in the risk curve and start taking up more risk in order to to buy those miners. We were seeing somewhat of an improvement, especially when you look at the miners to gold ratio, which I think it's a very, very important ratio to be looking at. Just look at GDX relative to gold, long term, short term. All of that is showing that we're seeing an improvement in that front. I think the skepticism was real. In other words, a few months ago, even when gold and silver were spiking up, I've seen a lot of macro investors still saying, I would touch gold, I would touch silver, I would not touch any of the miners. I think that has somewhat changed recently. And given that, you can see even though gold and silver prices have declined significantly, some of the miners have held up pretty well, especially the smaller names, in my opinion. At least what we hold in our portfolio that we can track. We know that this decline has not been as bad for us or for any investor in the space of earlier stage companies than the other parts. Now, answering your question, look, I'm starting to see more and more value investors come up to me and say, hey, some of the miners are starting to show up in our models. I can say that at Crescat, in some of our quant models, some of the miners are beginning to score really well. Newmont scores incredibly well in our model. That was not the case in 2015, for instance, when a lot of people were comparing this run up that we saw in 2020 with those times, thinking that we're going to go through another period of decline in the industry. I don't agree with that at all. And so I think that the growth in fundamentals at some point, another important point is that the easy money has really drove investors' mindset to look for growth, most importantly, and therefore why we're seeing tech companies and some other sectors doing so well. I think the fundamental story is obviously not being pricing the way it should be. And so the fundamental investors or value investors are not being really paid the right way here in terms of being successful of picking those stocks. As cost of capital begins to rise, I believe profitability will begin to be a much bigger part of priority for investors, which has not been so far. It's been top line growth, one of the biggest priorities for why you should invest in an equity or in any company today. And so I think that this new regime of inflationary forces rising, cost of capital rising, us really reaching an inflection point for a lot of those macro factors, including inflation, inflationary forces, given the amount of stimulus that we're seeing, may create a change in how we factor companies, how we look at companies, which I think we're going to go back to value investors being well rewarded for really doing the research. Today, you buy any company and you wake up and that company is up. It's you don't need to put a lot of work on it. So certainly, I think that's about a change. Profitability is probably here to stay now, and it's we've seen some of that change going on already since elections and since the vaccine news back in the late 2020, and I think that's only going to continue.
Interesting comments. You made a couple of mentions I want to follow up on it because I got to give you a bit of contra at this point. And I'm curious, like, what do you say to that, right? So you used Newmont, for example, as an example. And I think it's a great case study because they've done a couple of things to attract more of a generalist investor and be more attractive to pension funds, meaning they increase the dividend. I think they're trading around 3.5% right now in terms of dividend yield. And they're starting to buybacks. And of course, they're debt free right now. Right. So that's what I was hinting at. Like, what do the miners need to do to become attractive? And maybe to extend on that comment, the miners seem to be doing the wrong thing at the wrong time, in my opinion. Right. So now they're all debt free while we're in a very low interest environment, but they're full of debt when we're in a high interest environment. They've been getting a lot of crap for that. Now that they cleaned their balance sheets up, we're in a low interest environment where they actually should be having a lot of debt. And you brought on the tech companies that actually don't produce any free cash flow. They have a ton of debt, but they don't care because they're paying 3-4% max on interest while they're growing. Right. So should the miners completely change their model? And I think Mark Bristow is a bit stoic, for example, at changing that model. Like, let's go out there and buy stuff while you can finance it for 2, 3, 4, 5%.
Sure, I think increasing debt is a fine strategy at the point that we are today. The fact that you said it's not going to change in terms of doing the wrong things at the wrong times. I think that's part of any commodity cycle, right? And the fact that we're seeing quite the opposite, if you just aggregate equity dilution, I mean, all of us know that miners are very well known for diluting capital in a massive way. And instead, what we're seeing, if you look in the aggregate terms for the top 50 miners, I don't have this chart here, but I just worked on that recently. We're actually seeing a decline on that. In other words, they're buying back shares, something we've never seen before to the degree that we're seeing today. So this massive, I mean, it really is conservatism at the end of the day. We've never seen this much conservatism, I would say, at least in my lifetime. And the data that I look at, which is going back at least 30, 40 years, I can't find this level of conservatism at a time when we're seeing, all the perfect macro factors for gold and the drivers, this huge tailwind from a political and macro perspective that we've never seen before, and pessimism in the whole industry, pessimism in the whole space. Now, regarding the changes, what they have to do, look, first of all, we've been seeing a decline they're tying up their ship. I mean, obviously, if you look at the declining cost has been somewhat, it hasn't been the largest decline in history, but it's been getting better. Balance sheets have been getting a lot better. But that's what you kind of need to do in order to attract capital, first of all. It's just that we've been in this late cycle environment in terms of risky assets for so long that it's not attractive for anybody to buy something that has a value proposition. The thing that is happening, however, is that we're starting to see growth metrics showing up for miners. So a lot of free cash flow growth factors, revenue factors are starting to show up. Obviously, in the last quarter, given the pullback in metal prices, that is going to also have a pullback in that data. But I think that's just the beginning. We've had almost quarter after quarter of incredible news for the miners, and so it's sort of normal to see somewhat of a pullback in fundamentals and also prices of the underlying securities such as gold and silver. I think it's natural to see this behavior of being very conservative when they should be being aggressive. How many miners now, starting to look at copper projects when they really should be looking at copper projects 6 months ago, right? We've seen this over and over again, and it's happening again today. So many companies changing their names a few years ago, getting out of silver exposure, trying to at least show that they're not with so much silver exposure and trying to make themselves more of a precious metals company. And now we're seeing some of that shifting back, companies changing their names and putting silver in their names. I mean, those are all types of trends that you see, in my opinion, when companies begin to get some confidence. And I think this is great, this pullback right now, because it allows any investor to really raise money at a situation where nothing has really changed. The macro reasons to buy gold and silver are intact. The whole thing that happened recently was a nominal rates increase, which is also a bubble, right? We all know sovereign debt is a massive bubble. And we all know as well that the Federal Reserve has to suppress those rates at some point. We just don't know at what level. And so at some point, they're going to have to suppress that again. And we'll give again a support for precious metals, in my view. So it's time to be focused on the long term, and look for companies that do those, that act more, that are aggressive in the bottom of the cycle of the gold cycle. But it's going to be difficult to see what you're talking about, which is companies taking up on that at the early stages. I mean, that's probably it's going to be the case in the next cycle and in other cycle. It's always going to be the case, and that's why we see this early stages, a lot of signs of that going on today. Companies buying back shares, and that's not going to be the case. We're going to see misallocation of capital. We're probably going to see a bubble in the gold space at some point too. And so, for me right now, we're so far away from that I'm trying to focus on good projects. And that's all that we do at Crescat right now at this point. But I hope I answer your question. It's not an easy answer to.
No, it's not. There's so many factors going into it as well. Like COVID plays a major role in terms of doing due diligence for takeovers and all that stuff as well. So it's a bit of a wild card, right? But we are thinking in our office as well, we're scratching our heads like, It has to start at the top, of course. It has to be the Newmonts and the Barricks that attract major capital before it starts trickling down. So we're wondering, like, what can they do differently to make that happen? Right. And that's one thing. But before we talk about like, and I have a couple more questions for you, and then we're going to wrap this up here. But I want to zoom out for just 1 second to more of the beginning of your presentation. You were talking about debt GDP ratio. And one question I have there, what can the US actually do to increase the GDP to lower that debt GDP ratio? And one thing that comes to mind, I'm going to throw that out there, is war. Okay.
Oh yeah, that's
right. And that's something that hasn't been discussed yet. And it popped up a couple times in your charts, was World War I, World War II. And like me in my Twitter echo chamber, I do see saber rattling happen. Right, it's happening in the Ukraine. It's happening in Taiwan. China is taking their Navy ships past Okinawa. So there's certain stuff happening that at least I'm closely watching. So how do you see the U.S. changing their GDP to debt ratio? Is the main question.
Yeah, I think there's a few options. You know, the war scenario is one of them, and it's usually we see an increasing debt prior to those that then leads to a war. So a large increase in of fiscal spending in preparation of a conflict. So that's very normal. But I think that the biggest case, I would say bull case for getting out of this situation would be through innovation. I think that's the biggest bull case for the U.S. in terms of what we've seen some of those in the past. Industrial Revolution was a major innovation time where it really helped the economy in general to really grow GDP relative to debt. Do I think that we're going through that again? And I think about this question all the time, because the whole reason why I want to be buying gold and buying silver is one of the supporting points is that the Federal Reserve is trapped. We're not going to see organic growth in the economy here in the US. And so the only way you can see that is really through innovation, that you can get out of this imbalance. Do I think blockchain is going to make that shift? I don't think so. I might be missing out something here, but I don't, I'm not saying it's not a great innovation. I'm not saying that artificial intelligence, automation, machine learning, all those different technological patterns we're seeing more recently and developments may not create a lot of wealth. But to the point where we see GDP growing faster than debt, I'm not sure. I think what drove a lot of those innovations that we're seeing recently, especially, was the cheap debt. And it's kind of interesting to think about that was actually the cheap debt that created even Bitcoin, an alternative for fiat currencies. And so I think that would be the question: is can we have innovation? I stand on the side that I'm not seeing any patterns where a growth and wealth will be created organically, and therefore I continue to see Federal Reserve and the government to have a lot of hand holding in the economy going forward. And this is going to have a lot of implications where tangible assets should be benefiting from this environment. But yeah.
Yeah, just one follow up to that, and then we're going to switch over. Is the green energy wave, innovation in that regard, creating value, because those products are usually more refined, they're higher quality, more technological know-how goes into those. Do you see that helping bridge the gap to a degree?
I think those are some of the important. I think it's an agenda that justifies the reason for large deficits. I think in order for you to run large deficits, you need a reason for it, and the green agenda certainly serves that purpose very well. Is that the thing that is going to create innovation? I mean, most of us know that a lot of those projects are not profitable unless they have government support. So no, I don't think it's what changes that. I think it's a whole supporting thesis from going from the old economy to the new economy. And everyone forgets about how to get there, which is the commodities, is the highway to get there. And that highway has been cheap, given the price of commodities over the last decades. And I think that's about to change. So those green innovations are going to come at a cost too. It's going to be a pretty large cost. And so another reason why we're seeing this increase in oil prices as well, which is counterintuitive, but I love oil, given exactly what you just said. This pattern is is definitely giving a reason for investors to buy oil, given, also very similar to the precious metal space, is declining capex that we're seeing in even more pronounced in the oil space. And so that's also going to have a lot of implications on that.
Okay, let's talk about Crescat for just 1 minute, and then we can put a bow around everything. How are you allocating your funds now?
So when you think about the Lassonde curve right now, most of Crescat's assets in the precious metal space, I mean, when I say commodities to equity ratio, I mean it. We're definitely positioned accordingly. We think that shorting the equity market, even though equity markets may continue to rise, we're fully aware of that. It's just one hedge if there is a deflationary spiral, given the level of imbalances that we have. So the way we're thinking about this is buying commodities and having some hedges by being short equities. So in terms of commodities, in thinking about the Lassonde curve as an example, most of our investments today are being deployed in the early stages and discovery stages of the mining cycle as a whole. We have some investments in the development side of things. So we've done a strategic strategic partnership with Quinton Henney, where we've been looking for some of the best projects in different geographic locations that we feel comfortable with. And that has been an incredible way of doing an activist approach of helping those companies to succeed. Some of them actually have been presenting in our event. And can assure to how we are working with them, and so it's been very great. There's always two aspects of every company we buy. One aspect of doing well on the activist side, helping the companies to infuse capital in the right places, tell the story, help them with expertise, i.e. SK Mining is a great example of a company we've had tremendous success helping them out. Eloro Resources in Bolivia is another one that we've had a lot of involvement. And Newfound Gold is another one. And so those are the part. And then the second aspect of it, so the first aspect is the activist approach, is the macro reasons to be buying those companies. If we think that we are in a secular bull market for gold, silver, and commodities, it's time to be invested in the very early stage companies. So again, there's a lot of not very good projects out there. I'm not going to name any of those, but we're very selective and looking for the right projects. And so I think that we've had a pretty good handle of about 60 companies in a portfolio that we have a very large involvement with all of those.
Fantastic. Tavi, this was super insightful. One last question we got from the audience, and let's see if we can keep that one short. It's Bitcoin versus gold. Do you think it's a competition or alternative, or can they coexist?
Well, certainly that has been somewhat of competitive space recently, but I don't see, I always joke around Bitcoin is probably going to be the most useful metal in the world. It's not a metal, so it's never going to be replacing gold. And central banks buy gold, not Bitcoin. That is not to say I'm a bear on Bitcoin, but I do think that gold serves its own purpose. And it's kind of ridiculous when I hear those ideas that it's going to replace gold. Replace on what? I think gold serves its own purposes, just like silver. If we're going to go from the old economy to the new economy, if we want to have blockchains and crypto assets running accordingly, we're going to need commodities as a whole. So, I think people that focus too much in innovations are not focusing on how we get there. And so for me, electric vehicles, all of that is all linked to commodities. And so I think that's the whole reason why we believe that commodities is has such a important value proposition today relative to a lot of other assets. But cryptos, especially Bitcoin, is an alternative for the monetary system. And it's the most speculative one out there. That is not to say it's a bad thing being speculative. Just be aware of that. That's speculative, just like silver. And so I think that's one reason. There's so much money slushing around, and it's giving a purpose for things like the most speculative ones to run even hotter. And so it's actually a great thing. I think people hoarding money, given what we're seeing in terms of the policies, is very, very important to our precious metals thesis as a whole. Finally, people are starting to be worried about the monetary dilution that we're seeing to the degree that we saw in 2020 and 2021. So that would be my best way to answer that question.
Phenomenal. Tavi, thanks so much for joining us. This was extremely insightful. Really appreciate your time. I know it's valuable because I know you're involved in a lot of things these days. So I truly appreciate you joining us this morning. Thanks so much.
My pleasure, Ty.